The December inflation in India is proving to be something of a dovish pivot for the markets. Bond prices and the rupee touched multi-month highs yesterday in intraday trades. So why was the data special? The December CPI at 5.69% was way below market estimates, but more important, below RBI's forecast. So if inflation is going to undershoot, will RBI change its stance? Will it loosen liquidity at some point? At least two entities, Citi India and ISec PD, believe, yes, Reserve Bank may change its stance as early as February. And today I have both those economists with me as my guests, Samiran Chakraborty of Citi India and Prasanna of ISec PD. Gentlemen, good morning and thank you very much for your time. Samiran, you first. What's so special about the December CPI?
So, Latha, what's happening is that we are seeing two parts of the inflation basket which are moderating. One part is obviously core. Not only is the momentum in core inflation much weaker, but it's also extremely broad-based. So just to give you a sense of numbers here, out of the 24 different categories of core items, 20 of them are showing less than 4% inflation. And the other factor which is important is that the non-vegetable food prices are also coming off quite sharply. This is one component which post-COVID has never fallen below 5%. So that has been the most persistent inflation that has stayed in the system. Now that is also correcting. So all put together, we think that for the Jan-March quarter, there is about a 60 basis point of forecast revision possible by RBI from its current estimate of 5.2%. We are at 4.6%. So that's quite a substantial drop in inflation, which might make the MPC think differently about their trajectory going forward.
Okay, fair point. Prasanna, your report also very strongly argued that there's something special about the December CPI data. Optically, for me, I mean, the CNBC TV 18 poll was 5.9 and the number came in at 5.69. 21 basis is not something we celebrate so much. Yes, it's important. But what did you find in the details that was convincing?
No, I think the story was or continues to be core inflation, I think, as Samiran pointed out. So, and that's been a continuing story for quite a few months this financial year, even as the headline inflation turned quite volatile. But I think even outside of core, when you look at food, and again, when you kind of differentiate within the food basket between the sticky items and the volatile items like vegetables and all, I think there is a clear sense that some of the more sticky items are also kind of decelerating. Like cereals, for example. And we know that anyway, seasonally, I think vegetables are entering a phase where anyway prices are going to come down. So I think that worries over food inflation, which was there earlier, and there are other indicators like rabi sowing, global food prices, and if you look at crude prices also. So broadly, I think the outlook looks favorable, and we are entering a period where anyway food inflation will come down and core inflation has moved below 4%. And also, we shouldn't forget, I think growth is basically entering a phase where it's also slowing down now. Obviously, 7.3%, what the NSO said, we don't think that's a right kind of estimate. It's going to be lower than that. But net, what we know is that first half of last fiscal year, growth was higher. Second half, it's decelerating. And probably going into next fiscal year, it may decelerate further. So if you put all that together, then clearly I think the inflation outlook, I mean, we have clearly seen the peaks in inflation. I think from now onwards, it's going to ease. And I think next year, what the RBI has forecast, I think earlier in their NPR, around 4.5% average, I think that looks quite credible now.
Okay, not just credible. Prasanna, Samiran has brought down his fourth quarter number to 4.6%. The Reserve Bank's number is 5.2, right? Are y'all also forecasting a lower, I mean, the undershoot is not December, but also into Jan, Feb, March?
Yeah, so for us, we have penciled it at 4.9 and not as low as what Samiran is saying. But clearly, I think the direction is very clear. Like it's going to be below what the RBI has estimated. And, and like I said, because seasonally, it's a quarter where food prices come down. I think we have to say the bias is towards the downside. So we can say 4.9, and probably there is a probability or there's a possibility it can be lower than that. But direction is important. I think it's going to undershoot RBI's estimate, and that kind of sets up the economy well in terms of inflation heading into the next financial year.
Okay. Samiran, the point that Prasanna touched about on growth, the other fear for Reserve Bank will be if aggregate demand, I mean, if growth is very strong. And, the wealth effect from stock market gains, could also that be a worry which might keep the Reserve Bank from changing its liquidity and monetary policy stance?
So this is one of those sort of little bit of a puzzle that despite growth consistently surprising on the upside, we are seeing core inflation surprising on the downside. So part of this is some kind of well-known data issues like the housing inflation number appears to be too low. And in general, services inflation consistently moderating at a time when urban consumption has been very strong is a little bit of a challenge to explain. And maybe those things will be there in RBI's mind when they look at their overall policy. But the point also is that we had almost 4 years of average inflation at more than 6%. So we should not be celebrating one or two good prints also too fast. We have to be a bit patient on that front. So that's why in our base case, we think the RBI will change their stance only in the April policy and not in the February policy. But February policy could be a live policy in terms of a more heated debate on this issue.
Liquidity. If the Reserve Bank was convinced of this argument, it would be more generous with liquidity, right? Prasanna, yes, they have done a couple of repos and given money to the market. But that was also because the market was unusually in deficit. I mean, December 31st, end of the month, normally you see the deficit reducing. This time it was higher, and therefore, at least I thought that is why the RBI is giving money. It has not moved the market into even, closer to surplus or even balance. So are you convinced that the Reserve Bank is convinced?
Well, I think the system was in deficit even before December also. We saw deficit for weeks together. We saw deficits in November and even in the first half of December. I think you should remember that RBI gave this repo operation after the FOMC meeting. Now, I'm not saying they just followed FOMC and Powell's comments on rate cuts, but surely it's not a coincidence. So I think the easing of global financial conditions also played a role in RBI changing its mind. And the way I look at it, they were doing 7-day or fine-tuning operations. But I think in the last round, I think they have announced the 13-day, which is basically a 14-day operation, which is their main operation. Since they've moved to repo provision using the main operation, I think that is also a signal in my mind that the liquidity framework or whatever the liquidity stance itself has changed. Now, again, I think we are not saying that RBI should turn around now and infuse durable liquidity and cut rates and those kind of things. We are not saying that. What we are saying is that you change the stance because withdrawal of accommodation doesn't make any sense now. Your rates have peaked. Your liquidity is in deficit. It's no longer in surplus. And therefore, the whole stance of withdrawal of accommodation doesn't make any sense. So you move that to neutral. You continue providing liquidity through repos. And as far as rate cuts are concerned, you can take your time. Obviously, we think the Fed itself won't cut before May. So there is no reason for RBI to kind of rush to cutting rates. But clearly, the stance has outlived its utility, we think, and it probably will end up confusing. Maybe in financial markets, people follow these things closely, they will ignore the stance. But in the banking system and the broader financial system, I think the stance has kind of lost its meaning and it can actually confuse people.
Okay. I have to quickly wind up. So I want some numbers from you all. Prasanna, where do you see, bond yields, whether they agree with your interpretation or not, yields have fallen. So the market itself seems to have moved that the Reserve Bank will soften. Where do you see yields, say by March or even for that matter by June? Because we are going to see bond index inclusion, we are going to see a likely softening by the Fed, your bond trajectory.
Yeah, first things first, I don't understand or I don't agree with the rally in the 10-year, right? Clearly, if liquidity is going to soften, if RBI is going to cut rates, it is the short end which should actually benefit. But in India, anyway, everyone trades the 10-year. I think the 10-year is like a shorthand for interest rate futures, I think. So everyone trades that. And therefore, that is rallying. But so I don't agree with the extent of rally because the curve is already flat. But that said, what you're saying is right. I think both these factors will play a role. Policy pivot is in the cards, as well as bond inflows from overseas investors. So I think 10-year can hit 7%. I'm not sure it will hit it in this quarter itself, or rather, if it hits, whether it will sustain there. But over a slightly longer period, this quarter and next quarter, going up to June, I think clearly 7% will get tested.
Okay. Well, Samiran, even the rupee strengthened for whatever reason. I mean, we've seen the strong debt flows all of last year, second half, as well as on Friday last week, $109 million of debt flows. So your trajectory for bonds, 10-year, as well as rupee.
So, Latha, I agree with Prasanna that the bond rally initial days in this quarter might be slightly tepid. So we think that 7.1, that sort of a range for the near term. But as we move into the next financial year, as RBI does its change in stance, and then if our forecasts are correct and RBI does 50 basis point of rate cut, and on top of it, we get the bond index inclusion related inflows, then we see a possibility of 10-year bond yield even drifting closer towards the 6.5% mark by end of FY25. On the rupee side, our near-term forecast of 80 to 80, so rupee is hovering close to that now. It is quite obvious that RBI has allowed a bit of appreciation in the new year. The balance of payment support was there for a while, even in December, but now with central bank allowing a bit more appreciation bias, it's to be seen that at what is the next level where RBI kind of stands and says that this is where the valuations they would want it to be. In terms of the overall backdrop for the currency, it has been quite favorable. So don't expect things to change in the very near term. But over the medium term, our house view is of dollar strength to come back in the latter part of the year. That could mean some reversal in the USD INR rate as well. So we expect the longer term view to be closer to 84.
Okay, got that. Thank you very much, Prasanna and Samiran, as always, running short on time. But I think both of them are telling you something very important in terms of the fall in the 10-year rate. Samiran saying that by end FY25, it could even go to 6.5. Well, our loans are tied to, market yields. More likely, of course, the repo. So watch out what they are saying. Chances of, cheaper loans are perhaps there 1 year down the line. Wrap up on Bazaar on that note. Chartbusters up next.